Here we are. It's the Real Money Show. My name is Jeremy Wiseman. I'm joined with Jerry Correia. We have a lot to talk about today, especially since the price of gold and silver are down. Demand is crazy high. Haven't seen anyone looking to sell anything, so this is a very strange thing that we're seeing in the market right now. The number 18778 silver, the website guildhallwealth.com. And Jerry, let's get right into it. I was just reading an article which really summed up everything. In fact, I had listened to the podcast by Peter Schiff, and this article sort of sums up that Peter Schiff podcast. And let's just read some of it because I think it's going to set up the rest of the show. It said, this is from Zero Hedge, having broken below $1,800 earlier in the week after suffering a death cross, gold prices are plunging this morning on heavy volume as real yields soar. And it goes on to say, when will people stop selling gold and silver and realize that rising inflation is not a one-time threat that the Fed will stomp out by raising interest rates and tightening monetary policy? So let's just quickly back up here. This was a week that Jerome Powell spoke to Congress, testified to Congress, and was very, very, very dovish, basically saying that interest rates, no looking to see interest rates rise anytime soon. So Peter Schiff explains, the Fed are going to do nothing. The dollar is going to collapse, which is the mother of all tailwinds for gold. And so, at some point, it's going to happen. But in the meantime, they're simply creating more buying opportunities for people who have been really slow to pull the trigger on getting their precious metals, getting their mining stocks. In effect, Powell this week was telling the market, don't worry, we won't be tightening monetary policy for years. Despite the fact that commodity markets are screaming inflation, oil, industrial metals, grains, beans, they're all making big gains. The only thing that is not catching a bid is gold. Schiff continues, for some reason, people are still thinking that rising rates are bad for gold and silver. But they're really bullish for everything else. But the reality is they're not. They're more bullish for gold and silver than any of these other commodities. In fact, here is the reality that nobody wants to acknowledge. As interest rates are moving up, rather than raising rates and reducing the size of QE program, it's going to increase the size of its QE program. This gives us a lot to talk about, Jerry, because first, let me just say, as far as interest rates go, back in 2006 and 2007, when Greenspan was the chairman of the Federal Reserve, they were raising interest rates a quarter point every time they got together. And I think they raised it 12 times in a row. And it was a very interesting time because one day they'd raise it, and on that day, gold would go down. Okay. And the next time they would raise it, gold would go up. There was no rhyme or reason to what would happen on gold on that specific day that interest rates went up. But the overall arcing story and narrative was that if interest rates are rising, they must be trying to fight inflation. Shouldn't I own gold? And so eventually gold would catch up.
Mm-hmm. And that's what we're seeing today with the U.S. 10-year Treasury yield. This is the main headline that has grabbed everyone's attention. It can either mean that the U.S. Federal Reserve is looking at some sort of a tapering, triggering the taper tantrum, or, as I've alluded to before in the other shows, that the 10-year Treasury yield it could potentially indicate further inflation coming down the pipe. So I'm of that opinion that we are going to be seeing inflation. As we can see, other asset classes have been beneficiaries of stimulus, massive stimulus. We're seeing asset class bubbles all over the place, minus gold and silver. Very exciting time, and it does sound very cliche going back to Schiff. Yes, this is a great buying opportunity. It is. This is exactly what they're doing. They're job owning. They're using their podiums to talk, to trigger algorithms. And that's what's happening, because historically, well, going back a few decades, every time they mention yields are rising, there is a computer algorithm that says Time to dump gold because we want to chase a little bit of yield. What's the yield, by the way? It's 1.5%. Is that the rate of inflation? No, we know the rate of inflation is a lot higher than 2%. So we're not here to chase yield or roll the dice. It's a computer algorithm, very short-term, temporary knee-jerk reaction. We have to be calm in light of all of the noise and filter through it all, as I always say. We have to filter through and see for what it is. This is a huge, huge buying opportunity.
And what I don't understand about it is, you see these prices come down, although we've seen these type of actions before. But to quote an article I was also reading earlier, that silver and gold are sticky. Meaning once you buy the physical commodity, it's not so easy to just snap your finger and sell it. You can buy and sell a cryptocurrency on a whim. Even a stock, you kind of have to at least wait for it to catch a bid or whatever it is. So, you can buy and sell stocks pretty easily. Currencies, you can get into those and the cryptos very, very easily. But when it comes to metals, you don't just sell on a whim. You don't see the market go down 2% and say, that's it, I'm getting out of this, right? We haven't seen a single person sell. A single person. Now, I've had a couple calls personally of people, what would it cost me if I wanted to sell today? I think at the end of the day, maybe we've bought back less than 15 ounces of gold in the last 2 months.
Because rational minds are looking at, right now I'm in my precious metals. If I sell the precious metals today, which are undervalued, which are not a bubble like everything else, I sell the silver and gold today, great. Where am I dumping it to? Where am I going to park those proceeds to? In Canadian cash? In US dollar cash? Not a very good decision. So we have rational thinkers, we have rational clients and rational investors that are, no, you know what? I'm not going to be selling today. I'm actually going to be accumulating some more because I see the bigger picture. I see the world needing the physical commodity. There's talk and chatter of a commodities boom, and we do believe that this is we're seeing canaries in the coal mine. Dr. Copper talking to us. We're seeing platinum, palladium, the big reversals. The ratios are rattling, and extremes we burst, and gold and silver are primed and ready to go.
The number 18778-SILVER and the website guildhallwealth.com. Remember, everything we do at Guildhall is physical. You can buy silver, gold, you can put it into an RSP, you can buy it, take physical delivery, or even store it in our vault facility, which is independent outside the banking system. We have a motto: if you can't hold it, you don't own it. So that's really the key for us, is direct ownership of the metal. And remember, we're not your advisor, so seek the advice of those you trust and make sure that you're considering the risks when getting involved. We don't typically view this as an investment. We do personally believe it's just asset ownership. Like many other things, you might own a house, you might own fine wines, you might even own a natural fancy colored diamond. And these assets do increase in value. But again, we're not your advisor. So with that said, we're talking about inflation. We're talking about the fact that there's some mixed signals in the market that somehow gold and silver are going down at a time where there's no physical product available. And with the lower prices, it's even harder to get that physical product. So what's going on in the market? Well, we know that Jerome Powell, chairman of the Federal Reserve, was testifying to Congress this week. And we also know that the yield was rising. So, Jerry, what is the significance of the rising 10-year bond?
It is a total diversion away from gold. We know historically the algorithms are set to sell gold if that treasury yield rises. It looks more attractive to go after a yield than offer gold that doesn't offer that yield. So that's what the algorithms are set to do.
Right. So the idea is that if the rate is going up, then I don't have the opportunity cost for gold disappears. I'm better off to hold the 10-year treasury and make an interest than why would I be paying for storage?
Yeah, so like this article from the Market Watch from Wall Street Journal writes that higher yields can simply undercut appetite for safe haven gold, which doesn't offer a coupon. Why is this happening now? Why is this so timely? We know that they cannot, that the Federal Reserve can't taper and and raise interest rates and do anything to their balance sheet. Quite the opposite. We have the new Green Deal, the 1.9 trillion stimulus package. We have the Build Back Better by Biden stimulus package coming down the pipe. There is no tapering going to be in the sight. We're seeing inflation actually happening, so that's why we're seeing this happen. And I think it's this is my personal opinion, I think it's a complete diversion away from gold. In the past few weeks, we've seen attention on the gold and silver markets, attention for going after that physical. And then when you have prices drop maybe by 1 or 2%, the not so seasoned investor may say, wait a minute, I may not want to jump into gold. But that's not happening, right? People are not selling their gold and silver, they're buying. And further, the MarketWatch.com writes that at some point the Federal Reserve will not tolerate rising treasury rates like we're seeing today and will implement their yield curve control policy, their YCC policy framework. And he writes, if the Fed ever announces a yield curve control policy, that would be massively bullish for gold.
So you didn't follow Game of Thrones, but I'm going to try to throw a bit of an analogy out here, okay? Stick with me on this.
I'll try.
So there was this character, and his name was Hodor, which translated to hold the door. And he was holding the door against a bunch of zombies for the others to get away, okay? That's all you need to know. Guy's holding a door, bunch of zombies are trying to get out the door.
Get out, okay.
So what is this all about? What's the analogy? The analogy is the Fed, imagine, if you will, this guy Hodor actually created these zombies, because that's what it is. The Fed has created inflation by printing all this money.
Right.
And now they're seeing the rates rise on the treasuries, and they don't want inflation. They say they want inflation, but they don't want inflation. Right? Certainly they don't want to go the way of Japan. They'd like a little, just to see that it's, we got to see a little. But the problem is if you open that door, the zombies flood out.
Yeah.
And what does the world look like when the zombies flood out, right? Stay with me. They're holding back inflation. And how do they hold back inflation? They stomp their foot on the yields. And how do they do that? With some zombies. They take some of the money that they're printing, they buy the bonds, and they push it down. Yeah. Right? So this is a crazy feedback loop that's occurring with the Fed. And the narrative and the fact that people would buy the narrative is absolutely crazy. And we know because we see people buying gold and silver every day, and they say the same thing every day. There's no way these central banks can print all this money and it not have any consequence whatsoever. I don't care how many degrees from Yale or wherever you got your degrees, you don't know what you're doing, right? You either do know what you're doing and it's criminal, right? Or you absolutely don't know what you're doing. It's like when Goldman Sachs was testifying for 2008 subprime crisis. So I don't know. We didn't look at the fine print on this. Saying, listen, dude, your brain is a point of ego for you. Yeah. Okay? It is everything. It is your entire existence is wrapped up in how frickin' smart you are and the fact that you work at Goldman Sachs. Yeah. And now that you're testifying, you go, I'm stupid. I don't know anything, right? And that's what these guys want to do. So you have to say, why are they doing these things? Why are they lying? Why are they being nefarious? Unless there's an end game here, or they're scared of what that end game is. And, you just know that what the Fed often does, and we've seen it time and time and time, the minute the crisis hits, they want more power. Give us more. This is your fault. If we would have had the power to do this would never have happened. And that's their answer to everything. That's their ultimate answer to every single collapse and every single panic that happens. Give us more control, even though we are not federal, right? We're a private institution, and you pay us for the money that we print. It's absolutely crazy. How you could want to partake in any of it is beyond me. What do you think?
No one does want to be a part of that.
First of all, did you like the analogy?
I love the analogy. That painted the zombie picture of everyone flocking out the door. That's exactly what's happening. And the people that are holding the door, the hammer has to fall on these guys. What we're seeing, though, is that people are not buying this anymore. They're seeing the lies. They see the truth. They're going after the truth and going after precious metals. They're looking at this a little bit more. They have a little bit cynical. They don't believe the narrative pertaining to these bankers. The fact is, I read a quote this week, and my wife gave it to me. It was from Dave Ramsey. Know your investments. And that's true. You want to know what you're putting your money into. And when you have lies and rules changing, like we talked about and we reported last week of how the SLV ETF prospectus changes. How many pages is a prospectus? Do you know what's in this prospectus? The average person doesn't even know what's in their mutual fund and what their MER percentage is. You don't know what you're investing in. But knowing your investments and seeing how things can literally change with these door holders, they're changing the rules on us. We don't want that. We want something that we know it's going to be there. We want freedom. We want to be able to pass something on to our kids, and our kids' kids can have something that is going to be there for them. That's going to be their down payment in the future. That's going to offer some security for you. And, this is why we talk about why gold and silver are money. Gold and silver are money because, it depends on where you are in the world and, what is this money? It's a phenomenon. If you're in prison, it could be cigarettes. If you're in Robinson Crusoe's on the island, it could be coconuts and water. That's money there. But for ages, what has survived was Aristotle's philosophy of what money is. And it's divisibility, portability, durability, recognizability, and scarcity. If it's not scarce, it's not money. So what do we have in our portfolios? Do we have money that's not scarce, or is it scarce? So the everyday folk should be looking at this and listening. Let's normalize our portfolio a little bit. We don't have normalcy until gold and silver are there, the investments that have stood the test of time, that are money, and there should be no rolling the dice anymore. We're seeing the risks, and the risks are on the wall. The writing is on the wall. Precious metals offer tremendous stability and will defend from the coming inflationary the cycle that's coming.
The number 18778 silver on the website guildhallwealth.com. I was listening to an interview with Jim Rogers, and he did another interview a couple weeks ago on Stansberry Research. This one was through Goldcore. It was really good. Some of the similar things that he was discussing, but if you're not familiar with Jim Rogers, he wrote the book Hot Commodities. He was one of the first hedge fund guys, incredible investor. One of the takeaways from his book was this idea that you always have an equities bull market, and then that's followed by an oscillating commodities bull market, right? It's like equities run out of stuff to sell and they have to recoup the equity, the commodities out of it. And he's still very keen on commodities, and he was talking about precious metals. And what he said, I thought, was, wow, I wonder if he's been listening to The Real Money Show, because he said about gold and silver, you have health insurance and you have home insurance. You need wealth insurance, and that's what gold and silver does. He literally said the exact same thing that we're always saying. And it's true. He said silver is down 45% off its all-time high. Show me something that is in that type of sphere that's that undervalued. It's part of the reason why the premiums are so high in the market right now, because it's so incredibly undervalued. And even on gold, it's like, okay, here's the price in the low 1700 range. Every major dealer out there has been restocking at higher prices, right? So now we're going to have to replace stock at the lower prices, right, and buy new product at the low prices. Who knows when that product's going to come in? And I've been through that similarly in my own portfolio, where silver was trading at 16.5. The price dropped down to 12. I'm rubbing my hands, licking my lips. Oh my gosh, let's get into the market. And I couldn't buy it for less than 19.
No.
And here we are. The price of silver is in the mid 27 range, I guess $26 today. And you can't buy it for less than $5 over spot, right? It doesn't matter where they push this paper price down. We're over the target. This is the important place to be.
And not only the average investor, but we're seeing the institutions having to acquire the gold according to the changes, which I'm going to talk about little later on the show, which is the changes, the massive Basel III changes with the Bank of International Settlements, and why they had to reclassify gold from Tier 3 capital, whatever that is, to Tier 1 capital, which is cash, which is money, which is liquidity, and which is your defense against insolvency. And when they reclassified it, these institutions had to go after this Tier 1 capital. So they're after it. Why are they pushing prices down? Maybe they're hunting for as much as gold as possible.
You know, one of the things we hear, Jerry, people will have a concern because we put a lot of precious metals into registered accounts. And one of the concerns they have is, oh my gosh, one day I'm going to have to pay taxes on this. You know, I'm going to turn 71 and my lira is going to convert to a LIF and my RSP is going to convert to a RIF, and I'm going to be forced to take this money out. I'm going to have to pay taxes on it. And I'm always I'm trying to educate on the fact that we don't need to be worried about this. You know, it's okay to pay taxes if you won the game. What do I mean by that? If you were to, the first thing is that when you put money into an RSP, you're deferring the tax. Great, you defer the tax. It means you've lowered your income, so you're not paying as much taxes. Now, the first hurdle, the first big hurdle is overcoming inflation. You put a loaf of bread into your RSP, and you need to get that loaf of bread out when you take it out. So let's just look at a 20-year horizon. So you're 50 years old. You're looking to start taking the money out when you're 70, 71. So the first step is we have to beat inflation. Well, if inflation's we'll undercut it a little bit just for the sake of rounding numbers. Let's say inflation's 5% a year. That means every 10 years, you got to be making at least 50% in your portfolio. And over a 20-year period, that means over 20 years, you have to double your money, right? That's it. So you put in $100,000 at 50, at 70, that better be worth $200,000. Make sense? Okay, so we beat inflation. Maybe inflation's a little higher. We can adjust. Now you have to pay the taxes when you remove it, right? That whatever you remove is getting added to your income. So let's say it's 15, let's say it's 30. Okay, add that to your total gains. Just say, I have to make 100% in 20 years, and I need to make an extra 30, let's call it 50% to cover my taxes. And that way, whatever I pull out when I'm 71 is worth the same amount as what I put in today.
Correct.
If I put $20,000 in today, I want to make sure that in 20 years, whatever I'm pulling out is worth today's $20,000.
Exactly.
$20,000 in 20 years will not buy you what it buys you today.
Correct.
Right? So that's it. So then when you look at gold, you say, wait a minute, gold over the last 20 years has averaged 11, 12% a year. That means it's going way beyond what I need it to do, but it's doing it. And even if I approach as just the insurance policy of my portfolio, where I'm just putting in, you know, the 15% allocation, that's still doing its job, in my opinion.
Of course, yeah, it's exceeding our needs. It's doing its job very subtly, very quietly, and that's the whole point of gold. It doesn't shout a dangerous yield at us. It does its job versus inflation and loss of purchasing power. That's what all of our clients in the past year and a half have enjoyed in their portfolios. They're looking at their gold and they're like, whoa, the silver is up how
40,
much?
50% in some cases over the last 5 years.
And this is just the beginning.
Yeah.
And we've had these review conversations this past few weeks and just reviewing the markets, what we're anticipating. Yeah, that's just the beginning. Talking about the technicals, if we're going to talk about where silver and gold are going, very short term, we're going to be seeing another cycle higher. We're at the tail end of the cup and handle. And this is a massive bull structure.
Well, not only that, but if you're looking at silver, not getting caught up on whatever it's doing day to day, but you just say, okay, look at the numbers of how much electric cars are going up, how much the need for electric cars, all of the uses day to day for silver. They only mine $1 billion a year. It's all gobbled up. And the price is $27. What do you buy for $27? You can't even buy, you can buy maybe a latte and a magazine. Seriously.
Yeah.
Like magazines cost $15, right? So what can you buy with that? Look at the groceries.
Yeah.
I mean, Fed talks about inflation. No, we don't see any inflation.
Yes,
Listen, I guess Jerome Powell's just eating free at the Fed cafeteria.
Exactly.
Right?
Exactly.
They must order pizzas for free for his family because this guy's never been to a grocery store lately. He has no idea what a sausage sells for, right? So it's like you look at the price of silver, it's so cheap. How can it be this cheap? It's so hard to get. That's why the premiums are higher. Of course, this thing is going to take off. Don't worry about the day to day. I've had a couple people call a little bit, and they'll say, "Oh, gold's not doing anything. What's up with gold? It's really not doing anything." I have to remind them, it's only February, right? Like last year, gold went up 22%. It's down so far this year, but we're not even out of the first quarter. And let's wait where we are in the summertime.
Yeah, that's right.
And let's see where things are at. I mean, literally, so much has happened, and it's only the end of February. How do you feel about that?
Yeah, it's the same. I had a couple of conversations like that today, like what's happening in gold and silver, and that's where we have to kind of readjust and refocus from the short-term, day-to-day machinations of what's happening in these markets, and really look at the game plan. It's to reduce risk and to position ourselves for rewards. I think that's what every normal person wants. It doesn't matter if you're a doctor or a lawyer or a blue-collar worker or unemployed. Whatever you do have, you want to take as little risk as possible, positioning yourself with something that is really undervalued, that has some potential. And like you mentioned, yes, silver's so undervalued versus magazines and knickknacks. Silver is money. You translate silver around the world, it means money in how many languages? Over 20 some odd languages. This is amazing. And to own gold at these prices, it's a no-brainer. So, kudos to the people that got involved regardless of the noise. And we look forward to, transferring your money over and getting some more precious metals in your portfolios.
The number 18778 silver and the website guildhallwealth.com. Speaking of that, you would think, and this tells you everything you need to know. The fact that the price of silver's down a little bit. Ultimately, I keep my eye on a bigger picture and I say we had the first big dip in silver in 2020 back at the end of November, right? There's always tends to be something pullback near the end of the year. And then since then, it's just been quietly moving back up. I think the low in November was something like maybe just under 23, and it slowly crept up. We got back up to 30. Okay, you retested a high. Wonderful. Came back down to like the 26 range. We're still in the mid 26 range, right? And this is what you need to know. The price is down today. It didn't mean that all of a sudden magically all these bars, like we're a video game, like, oh, we won the prize, the market came down, here's a magic stockpile of silver, it just arrived, now the prices can go back down. No, the real world does not work like that. We are literally begging our wholesaler every day, saying, okay, here's what I think we can put through in terms of our time, how much time we have to put orders through. Here's what I think we're going to need for the day. And they're scrambling to help accommodate us. And that's important that they're scrambling, and it's great that they're doing that. But it doesn't make it any more available. It's literally, okay, what product do you have right now today that we can help our clients get into this market?
That's right.
That's in a down market? What does an up market look like, Jerry?
Very unstable, very explosive. It's going to be explosive, and it already is, I think, in my opinion. People are like me. They want to know that they can forecast silver in their portfolios, that we can acquire the silver. When people ask me, someone asked me today, what's the urgency like? How much time do I have to get the silver, Jerry? And I'm like, well, you know what? Last year I could have told you could have waited, nibble at the market, dollar cost average. Not so much today. You're not going to be dollar cost averaging anything. If you have any funds, 10,000, 20,000, 100,000, do it all now.
Yeah, you definitely have a little bit of a dichotomy between the savvy buyers from several years ago who would work with you and push you on pricing when, let's say, it cost $1.30 over spot to buy a 100-ounce bar of silver, and you might have to sharpen your pencil and get that down to like $1.10 or something like that. Now all of a sudden the premiums are $5 and there's really like no working room.
There's no
and you just wonder, there's going to come a time where the market's taking off and you just can't get in. There's just no product available. If the product is not available at this price, right? Who cares? It's a high premium on a low price is still cheap. So it doesn't matter. It's about getting in the market right now. And if you can continue to acquire, you do. And to that end, myself, I'm continuing to acquire at these levels. I have no problem continuing to acquire here, and the best place to do that is just either direct or in your RSP. The number 18778-SILVER, the website guildhallwealth.com. There's so much more to talk about here on The Real Money Show on Global News Radio 640 Toronto. Welcome back to The Real Money Show. We have a surprise guest, Paul Wiseman, president of Guildhall Wealth. Paul, how are you doing?
Hey guys, I haven't been on the show for ages.
I know, you've been really busy, and one of the things that you've been incredible at, literally putting on the Superman costume, is managing inventory. And, people will call and they'll say, do you have anything? And I almost have to feel embarrassed to say, is it bad if we do, that we've been able to manage some inventory, and I've got some 10-ounce bars, I've got some kilo bars. What has the last few weeks looked like for you?
It's been really tough to go out and find product. The mints, for some reason, are not making certain products. The Royal Canadian Mint, there's a shortage of 1-ounce gold bars. There's definitely a shortage of 10-ounce RCM silver bars. Maples, we've been getting a few. We've been able to source that. 100-ounce bars, we've had inventory for quite a long time, but we're not getting any new inventory. So every time we sell something, basically I have to place an order to replace what we're selling from our inventory. And it's getting, as I said, it's getting harder and harder. We are able to source product because I am forward thinking. I mean, I understand the markets. I've been doing this for a long time. It's the only thing that's got me baffled right now a little bit is that the prices of gold and silver, the paper price has been smashed down. The physical price, basically even on a 100-ounce bar, in Canada we're looking at $4 US spread between bid and ask. In the States, they're asking as much as $6. On Silver Eagles, we don't even bother bringing them in because the spread is too much. Gold is now gone. 1-ounce gold bars, the spread has gone from $40 to $50 an ounce US spread. So that's the bid, between the bid and the ask. Maples, gold maples, I think they're on the... I don't understand why there's such a shortage, but even those the spread is $65 over spot. It's like they're on the witness protection program. You can't get them.
So I know that some of the shortage can be explained in the sense of you have not just a dealer like Guildhall, but a wholesaler who buys a bunch of product from a mint at a certain level. The price goes down. They have to replace the product and then be able to let go of the stock that they currently bought at the higher price. So, I mean, they can hedge it and whatnot, but how much of the gold shortage is basically, what they would call in real estate like backup supply or overhang that they can't get rid of because it was purchased at a higher price?
Well, I think there's a little bit of that going on where they've committed. I mean, we're allocated product every month, but, what happens is there's only a very small amount of wholesalers, and they are allocated product, whether it's the Royal Mint, whether it's the US Mint, whether it's, coming in from Switzerland or whether it's coming in from Perth Mint. They're allocated a certain amount of product. So in good times, it's easy to sell your product. In bad times, when product is not moving, you start to stockpile. So again, if you haven't hedged your product, if you've paid $2,000 an ounce for gold, you don't want to be selling it at $1,800 an ounce. So
No,
you
right.
either have to push it to one side and you start ordering product at the new price, hoping that the price is going to start going up, and it's going to go up.
Right. So in that sense, though, you're only talking about a limited period where you've acquired gold, because every month you can only bring so much precious metal out of the mints, out of the refiners every month. And then you would literally need sustained pricing at this level for months out before you started seeing a lot of product coming back into the market. You also need demand to disappear, and demand hasn't disappeared just because the price went down.
But the wholesalers, as well as us, rely on product being sold back to us. So that's the secondary market. So, I mean, we're just not getting enough product back, for the secondary market. Now, you would think there's a shortage of product. People, the prices are being driven down. People are selling. No, they're not. They're holding. Gold is for your golden years. That's what Salenti always says, and I'm a great believer in that. If you buy every month or every couple of months and you cost average, it doesn't matter when, you see these prices dip, you can't even buy the product. Today we're recording this show Friday afternoon. I can't buy product. The wholesalers won't give me a price, and they won't give me a delivery date.
Oh, wow.
So, if I want to pay much higher than the $50 or $60 they're asking now, I can put an order in and hope that the prices don't drop.
That makes sense to me in a way, because and it's interesting because we have seen this before, Jerry. We saw this in March. The price went down too much, to the point where people were like, sorry, where the wholesaler was like, so we're not selling. Like, what's the point? This is stupid. We're just going to cut it off. Sorry, nothing available. Until this price starts to come back to some sort of realm of reality. We're going to come back to that. I noticed that back in March, we had kind of a hiccup. Not a hiccup, but we had a spike in views because we had the Gerald Salente interview. But it was right at the beginning of COVID, and people were really, I need my gold, I need toilet paper, I need gold. And then we had the silver squeeze recently, and so you had these two major machinations in the market, all in less than 365 days. What does this say to you going forward in the market, that you go, all of a sudden you had two earthquakes in the precious metals market? What does that signal to you for the next year or out further?
Yeah, if you're forecasting, and we try to forecast as much as possible, like Paul, like masterfully handling this inventory coming in, forecasting is very tough. But what we are seeing right now is for every 10 ounces of gold that are leaving the building here, 1 ounce is coming in, and this is not changing. The premiums have remained static. It's not moving. And plus, we're reading things from the Silver Institute and the World Gold Council that mining is going down year over year. It's going down. So to forecast where we are going to be, where is the silver and gold going? Are they holding on to? We can speculate all day long, and some speculation is saying that these major institutions, they call them systemically important financial institutions, are requiring the gold now because rules have changed. Back in March 29th, 2019, the BIS, who are the BIS, the Bank of International Settlements, who classify what Tier 1 capital is, Tier 2 capital, they quietly reclassified gold to become Tier 1 capital, meaning that they have to have gold or Tier 1 capital, about 10% on their balance sheets to do what? To stave off insolvency. They forecasted something coming. So they're forecasting issues in the banking system coming up. So this means these sci-fis, these institutions, need to find capital. Could the wholesalers be providing the institutions? I mean, we saw SLV changing their prospectus. They don't have enough silver. The other ETF, could it be being swallowed up by the institutions?
Well, you had one major player, Scotiabank. I mean, Scotia Makota got out of the bullion business, and obviously, whether they were supplying certificates to people at one time, they have to fulfill those now with precious metals, with physical product. So there's obviously it's took quite some time to get product to them, probably. They've had to take all the product they've had out of their facility because they're not in the bullion business and put it into storage facilities, into other vaults. I mean, everything's been on, has been on fire. But for all fires that go, they eventually go out. They get doused. They get put out. Whether it's a forest fire, a house fire, or even, real estate, cryptocurrencies, stock market. Eventually, it goes from hot to cold. You have to be in precious metals. You have to own gold and silver. You need 15-20% in your portfolio, whether you put it into an RSP, a TFSA, which I always advise people, if you don't have a TFSA, that's the best place to put gold and silver. If you want to hold gold and silver, put it into a secure vault. We vault for people, gold and silver. You can take product home. We do have product. It's limited. I mean, you can go to 50 websites and you'll see on virtually every website delivery 15 to 20 days to 30 days upon payment or clearance of check or clearance of payment or whatever it is. We have product, again, limited to customers. I mean, I'm not going to, if somebody wants 50,000 ounces of silver, you're going to have to wait. Mm-hmm. But we can supply you, an amount that's feasible. But same thing with gold. We have 1 ounce gold bars, we have 10 ounce gold bars, we have kilo gold bars, we have silver, we have 100 ounce bars, 10 ounce bars, kilo silver bars, and silver maples.
So the takeaway here is when product's available, you get your hands on it. This is a great time to do it. Even if there's some higher premiums, the fact is the prices are lower. This is an incredible window of opportunity. Jerry, 15, 20 seconds.
Gold is risk-free. This is what we want. We want zero risk with reward. And as the World Gold Council wrote and concluded regarding the changes of Basel III rules, their analysis shows that gold can be used in portfolios to protect purchasing power, reduce volatility, and minimize losses during periods of market shock. So to conclude, to the normal folk, for everyday folk, we don't want risks. We don't want to roll the dice. We want a safe investment that will go up in value.
Jerry, thank you so much. Paul, thank you for joining us. Great to have you back on The Real Money Show. It's been another great week. The number 18778 Silver, the website guildhallwealth.com. Look forward to speaking to everyone next week. This has been The Real Money Show on Global News Radio 640 Toronto.